variable interest rate comes down, the demand for the domestic currency also falls. The demand curve shifts to the left. The fundamental rate then would fall to the official rate. So E star is now equal to E par. And what we see then is this difference here shows us the gain in international reserves. Again, just the opposite of what we saw with an overvalued currency. Now here we might have to ask our question, how long can this happen? We saw with a overvalued currency, it can only last as long as the central bank actually has international currency or international reserves to sell. But in this case, we're acquiring international reserves. And what the central bank is doing is increasing its domestic money supply. Notice, central banks can increase their domestic money supply as long as they want to. Right? That's the printing press that we often think about. All we have to do is make an electronic credit in some seller's bank deposit account. So we can always increase the domestic money, or the central bank can always increase the domestic money supply. So it's not really a big issue there. They can acquire international reserves basically as long as they want to. Until, of course, they have all the international reserves in the rest of the world, which might be a lot. Okay, and just to give you an idea of that, these are the international reserves for China. Okay, it excludes gold, but generally we don't think of gold as international reserves. So one thing to notice is in 1995, so that's just 20 years ago, the international reserves of China were under $100 billion. Today, they are $4 trillion. That's a pretty big increase. And you can see that the real takeoff starts in 2002, 2003, something like that. Now, why would China want to have an undervalued currency? By the way, I'm not suggesting China had a fixed currency, although in point of fact it was fixed for some part of this time, as we'll see a little bit later. But why would China want to have an undervalued currency? What happens when a currency is undervalued? Your exports are cheaper on the world market. Foreigners will want to buy more of your exported goods. Imports will be more expensive inside the domestic economy. So your domestic residents will buy fewer of them. Your net exports will grow. So if you're a developing country and you realize the way to grow quickly is to get into manufacturing of goods in which you have a comparative advantage that you can sell to developed countries, why not make those goods as cheap as you can, not only with low labor cost, not only with low taxes, not only with low electricity cost and other types of production costs, how about with a low exchange rate? And so China's seeing very rapid growth on the export side, very rapid growth on GDP. Right? Net exports are growing, GDP is going to be growing. So one of the reasons that China has continued to have an undervalued currency is that they want to continue to use net export, or export growth in particular, as one of the drivers of economic growth. Now, this does raise an interesting question about China. If the People's Bank of China, their central bank, were to stop intervening in the foreign exchange market, would the value of the Chinese renminbi appreciate dramatically? Right? So think about this diagram. If they stop doing this, so the demand curve jumps back to this would suggest that the currency should appreciate, and appreciate maybe quite significantly. Right? By the way, notice that's exactly what our Big Mac index showed us on Tuesday, right? That there should be fairly significant appreciation of the Chinese currency. To know what's going to happen, however, it's difficult to only look at foreign exchange intervention in isolation. It's unlikely that the Chinese would stop intervening in the foreign exchange market and also keep their current capital controls. So notice what happens. Stopping intervening in the foreign exchange market says the currency should appreciate. But what happens if they relax capital controls? What does that say? The currency should depreciate. What's the relative orders of magnitude of those two effects? I don't know. And I don't know that anybody knows with a great deal of confidence. But we know we've got two effects going on, and both of those events are likely to happen at roughly the same time. That China will intervene in the foreign exchange markets less and less as they're also relaxing capital controls. So whether the currency appreciates or depreciates is still very difficult to know, in my opinion. Okay, as we said, an undervalued currency can be maintained for an extremely long period of time as long as you're willing to accumulate foreign exchange reserves. I might point out that this chart, different numbers on the vertical axis, doesn't look all that different from roughly the year 2000 on for most Asian countries, with the exception of Japan. Because most of those countries were economically harmed very badly in the 1997-1998 Asian economic crisis with those overvalued currencies, that basically the SCAR says we'll never let that happen again. And one way to never let that happen again is to have so many foreign exchange reserves that you just can't possibly run out. Of course, there is another way to make sure that doesn't happen. Let's have a floating exchange rate. Okay, this is just a summary of how we know whether the currency is going to appreciate or depreciate. You need to know what the central bank is doing. When they buy their own currency, they're taking currency out of circulation. Interest rates will rise, the currency will appreciate. If they're selling their own currency, the money supply will be increasing, interest rates will be declining, the currency should depreciate. Now, one of the things that we might want to know is how do we decide between perfect capital mobility, which we like, fixed exchange rates, which has some appealing features to them, and monetary policy, which we like to use to offset domestic shocks. Well, it turns out that this thing called the policy trilemma, tri meaning three, lemma meaning unconfused, right? Confused about the choices I have to make. So the trilemma basically says the following. If you have perfect capital mobility and a fixed exchange rate, you cannot have an independent monetary policy. In essence, your monetary policy has to be used to fix the exchange rate, not to be used independent of the exchange rate to try to affect domestic economic conditions. In essence, what happens is when you fix your exchange rate with perfect capital mobility, your monetary policy must reflect the monetary policy of the anchor country. So in Hong Kong's case, the Hong Kong Monetary Authority has to have the same monetary policy as the Federal Reserve. Whether it's the right policy for Hong Kong is not an issue. If they're going to maintain that fixed exchange rate, that must happen. Okay, and this is the way that it works. And let me give you a real-world example. Argentina, I mentioned, fixed their exchange rate to the U.S. dollar in the 1990s. In the late 1990s, the U.S. economy was booming. The Federal Reserve started to raise interest rates. If the Argentine Central Bank had not done anything, the dollar would then have started to appreciate, right? Higher real interest rates in the United States increases the attractiveness of the U.S. dollar versus the Argentine peso. Money flows into the United States, the dollar appreciates. But wait a minute. Now, that means that in a relative sense, the Argentine peso is depreciated. But we can't have that happen. We've got a fixed exchange rate. So how does the Argentine Central Bank come about keeping the fixed exchange rate? They also now need to make the Argentine peso more attractive. That is, they need to have a higher real interest rate in Argentina. So the Argentine Central Bank now needed to raise the Argentine real interest rate so that the Argentine peso now appreciated relative to the dollar depreciated. Now we're back to our fixed exchange rate. But notice the Argentine Central Bank had to do exactly what the Federal Reserve was doing. Here's the problem that the Argentina ran into. While the U.S. economy was booming and the Federal Reserve was raising real interest rates, the Argentine economy was in a recession. And the Argentine Central Bank is raising real interest rates. Think about that. We're in recession, and the central bank is raising real interest rates. Makes the recession even worse. And eventually Argentina decided they couldn't suffer the pain anymore, so they abandoned the fixed exchange rate, despite having a currency board. Shortly thereafter, the recession got even worse because the currency depreciated. There were liabilities and asset mismatches. Now all of a sudden, Argentina defaults on their sovereign debt. That was in 2001. We're still trying to resolve that issue. There was a court case just a couple of months ago about what Argentina can do and not do in the international bond market. So Argentina has not been able to borrow in the international bond market for now 13 years. Okay, so be careful when you set your fixed exchange rates. Okay, so the policy trilemma says, okay, we got three things: perfect capital mobility, a fixed exchange rate, independent monetary policy. Pick any two. I don't care which two you pick, but you can only have two. So the decision Hong Kong made, perfect capital mobility and a fixed exchange rate. So by definition, then, they cannot have an independent monetary policy. The U.S. made a different choice. The U.S. decided to have perfect capital mobility and an independent monetary policy. So the U.S. cannot have a fixed exchange rate. That's why the dollar bounces around all the time. China has made yet a third choice. They've decided that they would like to have a quasi-fixed, it used to be fixed, so it doesn't work quite so well, but quasi-fixed exchange rate and an independent monetary policy. So they can't have perfect capital mobility. So they restrict capital flows in and out of the country with capital controls. Right? So there are lots of different ways of trying to get to what you want, but you can only have 2 out of 3. So there's a pretty diagram that shows the impossibility trinity with the choices on the points and the options on the sides. Pick any two. I have no idea why they use those colors. Okay, now why would we pick one kind of exchange rate over another? So remember that while we think of countries as not having fixed exchange rates, there actually are a bunch of countries that have fixed exchange rates. Right? Every member of the Euro region has a fixed exchange rate. Greece has the same currency as the Netherlands. Germany has the same currency as Portugal. These are different countries. But having the same currency means that one German euro is equal to one Portuguese euro. Right? You might actually even think inside the United States we have fixed exchange rates. One California dollar is still equal to one New York dollar. So we've got fixed rates inside the country, but we just don't have fixed exchange rates outside the country. Okay, so why would we want fixed exchange rates? A couple of reasons. One is fixed exchange rates lower the cost of doing business across borders. Right? I don't have to worry about what's going to happen to that exchange rate. So it makes international transactions easier and cheaper. And that may lead to an expansion of international trade. Second, if your central bank isn't well disciplined in terms of keeping inflation low, a fixed exchange rate substitutes the anchor currency's monetary policy. This was why Argentina went to a fixed exchange rate with the US dollar to begin with. In the 1960s, 70s, and 80s, Argentina had very, very high inflation rates, up into the multiple thousands of % per year. Once they fixed the exchange rate and they basically had the Federal Reserve's monetary policy, in 2 years the inflation rate came down to single digits. By the way, Zimbabwe did the same thing a couple of years ago. 2007, the inflation rate in Zimbabwe was 2 million %. In 2009, it was 8%. They have a fixed exchange rate. So if you don't like your monetary policy because you got big inflation, a fixed exchange rate will help discipline that. Okay. It does require, however, that the anchor currency have a low inflation bias. And of course, that also is one way to bring inflation down very, very rapidly. If you think about Zimbabwe, how do you go from 2 million % to 9% quickly? You've got to change inflation expectations. But if you're in Zimbabwe, those expectations are going to change only if you've got a credible fixed exchange rate that people think you will maintain, and therefore you've adopted the policy of the Federal Reserve. Okay. Disadvantages. Okay. If you have perfect capital mobility, you cannot have an independent monetary policy. So you've given up one of your policy tools for dealing with economic shocks. Okay? And that can become a real problem. I gave you the example of Argentina in the late 90s and early 2000s. If your fixed exchange rate is overvalued, you can be open up to speculative attacks, as we talked about earlier with Thailand. Now, flexible exchange rates, they do have advantages, right? You get to have a very independent monetary policy. Even China, which even though they have a quasi-fixed exchange rate, they've gotten rid of perfect capital mobility, so they can have an independent monetary policy. Those independent monetary policies can be very important in terms of dealing with shocks. Remember, we mentioned earlier that monetary policy has the primary responsibility for dealing with shocks, rather than fiscal policy. Disadvantages of flexible exchange rates. They can be really, really volatile. More volatility means more uncertainty. More uncertainty generally means less economic activity, especially long-term activity. It also raises the cost of doing business across countries. If you've got a central bank that's not particularly well disciplined, you don't have that restraint on expansionary monetary policy. So fixed exchange rates would normally be better whenever the gains from closer economic integration would be large, right, where the cross-border trade volumes would go way up. Or if the countries can coordinate their monetary and fiscal policies closely. Flexible exchange rates would be better if you have a well-disciplined monetary policy, or if your domestic shocks are very different than the countries that you engage in international trade. Now, we often think about fixed exchange rates and flexible exchange rates as all there is, but there are shades of gray in between. And a shade of gray that's closer to fixed but still allows changes is something known as a crawling peg. Now, if you looked at relative purchasing power parity formula from Tuesday, you would have seen that a change in the nominal exchange rate reflects the difference in inflation between the two countries. Most developing countries have higher inflation than developed countries do. So a developing country, think Thailand back in the 80s and early 90s, had higher inflation than the United States. Its currency should have depreciated. It didn't, which is why it went from being undervalued to overvalued. Right? So a crawling peg would take care of that. That would allow that fixed exchange rate to be adjusted on a very regular basis. So this is China's exchange rate. Again, you can see fixed rate here, but this is what I would call a crawling peg during this period of time. A very regular appreciation of the currency on a daily basis. Okay, on flexible exchange rates, or closer to flexible, is something called a managed float, or sometimes a dirty float. This isn't to change the broad trend. Rather, this is just to kind of dampen the peaks and raise up the troughs and kind of smooth out some of the sharp fluctuations in the currency. Japan is probably the best example of a managed float. They intervene on occasion, but not continuously. Their foreign exchange reserves are still rising because what they've really tried to do is, especially during this period, slow the appreciation of the yen, but not to prevent it. Okay, have a great weekend. Go Bears. We got a big game coming up, so we need to see a win here. Have fun with your problem set, and I'll see you on Tuesday.